What these investment arrangements mean is that CPF members bear no investment risk at all on their CPF balances. Their monies are safe, and the returns they have been promised are guaranteed. Neither does the CPF board bear any risk, regardless of whether the GIC's investments earn or lose money in any particular year. The risk is wholly borne by the government on its own balance sheet. The government pools the proceeds from the SSGS with its other assets and invests long-term funds through the GIC. The GIC does not, in fact, manage SSGS monies on their own, separate from the other government assets. This is an important distinction which I will come to later. GIC is fund manager for the government, not owner of the assets and liabilities. It seeks to achieve the government's mandate of achieving good long-term returns without regard to the sources of funds that the government places with it. For example, whether they're proceeds from SGS or SSGS or government surpluses. But that is not the whole story. The average long-term return masks wide fluctuations in returns from year to year. You can have good average long-term returns, but what it disguises is variations which can be very significant from year to year. To answer Mr. Gerald Giam's question, over the last 20 years, there were 8 years where GIC's investment returns were below what the government pays on SSGS. A good example was the global financial crisis. As I stated in Parliament at the time, GIC's portfolio value in US dollar terms declined by about 25% during the 14 months from October 2007. October 2007 was a peak, and from then to December 2008, its portfolio value declined by 25%. GIC's performance was similar to that of other funds with a similar mix of asset classes, but it illustrated the market volatilities faced by every long-term investor. Hence, while the government expects to earn returns through the GIC over the long term that exceed what it pays on SSGS, and has done so in the past, there is no assurance of GIC's returns exceeding SSGS interest rates over shorter periods, much less every year. This is also because of the guaranteed floor on CPF interest rates, which do not follow declines in market interest rates. How then is the government able to meet its SSGS obligations in the years when the markets are weak and GIC's returns fall below what the government has to pay SSGS? The reason is that the government has a substantial buffer of net assets. Net assets meaning assets in excess of liabilities. The government has this substantial buffer of net assets, which ensures that it can meet its obligations. In years when investment returns are poor, the net assets have helped to absorb any losses and ensure that the government can meet its obligations on the SSGS as well as the market-traded SGS. Correspondingly, when investment returns are strong, the net assets grow. To address Mr. Gerald Giam's further question, therefore, no extraordinary measures have been necessary to enable the government to meet its SSGS obligations in the years when GIC's returns fall short. It is this role of government, with its significant net assets, that ultimately allows the CPF board and CPF members to be shielded from risk. The government, through GIC, expects to earn good returns over the long term, but the volatility can be substantial from year to year. The government has been absorbing that volatility and protecting CPF members. This is also the reason why no market player, other than the government, is able to take on the CPF obligations. The guarantor is not merely playing the role of a long-term investor. It also must have significant capital that provides a buffer when the markets are down. Our CPF system is hence sustainable, so long as the government continues to run prudent budgets and invests the reserves wisely. Then the government's balance sheet will remain strong and investment returns over the long term can continue to meet our debt costs. However, the GIC's good long-term returns also reflect the fact that it is managing the government's assets as a pool, which includes the government's unencumbered assets. In other words, assets that are not matched by liabilities. This is a critical feature of our system. The GIC is managing government assets as a pool, and this pool comprises not just assets that are backing the SGS and SSGS, but also the government's unencumbered assets, past government surpluses, proceeds from land sales, which under our constitutional rules have to be accounted for in past reserves. These are unencumbered assets, and the GIC manages the whole pool of assets as one pool. This allows the GIC to invest for the long term, including investing in riskier assets such as equities, real estate, and private equity. It would be quite different if the GIC, instead of managing the government's pooled assets, were to manage a separate, standalone fund to provide backing for CPF liabilities. A standalone fund would have had to be managed much more conservatively to avoid the risk of failing to meet CPF obligations. It would not be aimed at accepting risks that enable good long-term returns, but at avoiding any short-term shortfalls. Consequently, the returns it would earn over time would be lower than what the GIC can achieve in its current role. Finally, I should emphasize that the investment returns in excess of the SSGS rates that the GIC expects to make as a long-term investor are not simply hoarded away in the reserves. 50% of the returns from our reserves flow back to our annual budget through the net investment returns contribution, or NRIC. This currently adds about $8 billion to our budget annually. The NRIC has provided the government valuable resources that have allowed us to embark on new priorities for Singapore, including enhancing our social safety nets.